Hello everyone, and welcome back to Money Mindset, where we set your mindset for your finances. In today's episode, we're unpacking a significant event that's just rocked the banking world: the collapse of Republic First Bank. As the first bank failure of 2024, this incident has sent ripples across the industry. We'll be exploring what led to this unexpected downfall and what it could mean for the future of regional banking. So buckle up as we delve into the world of high finance and intricate banking systems. Let's break it down. Republic First Bank, a well-known regional bank, was seized by state regulators late last night in a dramatic turn of events. This Philadelphia-based bank had carved a niche for itself in the Mid-Atlantic region, boasting a portfolio with approximately $6 billion in assets and $4 billion in deposits. Its sudden collapse has sent ripples through the banking sector, marking one of the most significant events in finance this year. A closer look at the details reveals that Fulton Bank, another regional player, will be stepping in to manage the fallout. Fulton Bank has been designated by the Federal Deposit Insurance Corporation to take over Republic First's assets and customer accounts. This move aims to ensure a smooth transition and maintain customer confidence during these turbulent times. So, as we stand today, Fulton Bank will be taking over Republic First's assets and customer accounts effectively immediately. Before we delve deeper, let's discuss the Bank Term Funding Program. This initiative was introduced by the Federal Reserve to provide a safety net for the banking system following a series of bank failures. The program functioned as a lifeline, allowing banks to borrow substantial sums to manage their liquidity. Imagine it as a lifeboat, keeping banks afloat in a stormy sea of financial uncertainty. Collectively, banks borrowed a whopping $161.5 billion under this program. It was a significant move, intended to stabilize the banking sector and ensure that banks could continue to meet their obligations. However, the program ended just last month, and now the tide is turning. Banks are under pressure to repay these borrowed funds, and this is creating a new set of challenges. With the lifeboat gone, banks are navigating rough waters again, potentially leading to financial distress. In March 2020, a significant regulatory change removed the reserve requirement for banks. This was a seismic shift in the banking landscape. Traditionally, banks were required to keep a certain percentage of deposits on hand, a safety net of sorts, to protect against sudden withdrawals. With this requirement gone, banks found themselves with more capital to lend, which was the intended effect. The goal was to stimulate economic growth by making more loans available to businesses and individuals. However, this freedom came with a downside. Banks now had less cash on hand. This made them more vulnerable to sudden demand for withdrawals, or when loans went sour and couldn't be repaid. It was like walking a tightrope without a safety net. This change, intended to spur economic growth, also increased the risk banks faced. While this was intended to boost lending, it also increased risk as banks had less cash on hand to manage sudden withdrawals or loans turning bad. The economic backdrop cannot be ignored. For some time now, we've been experiencing high inflation rates. This inflationary environment puts a strain on the banking sector, as the cost of borrowing increases, making it more expensive for banks to maintain their operations and manage their debts. In addition to inflation, we've also been seeing expectations that interest rates will stay high for longer. Higher interest rates affect the value of bonds and other securities, which form a significant part of a bank's investment strategies. When interest rates rise, the value of these securities falls, leading to losses for the banks that hold them. Furthermore, these economic factors don't operate in isolation. They interact with other components of a bank's balance sheet, such as loans. For Republic First, it was carrying a heavy loan burden. When this loan burden is combined with high inflation and interest rates, it can create a perfect storm that pushes a bank towards collapse. For Republic First, these factors combined with a heavy loan burden may have tipped the scales toward failure. The collapse of Republic First Bank could be just the tip of the iceberg. Regional banks, often more ingrained in local economies, face a unique set of challenges. The operational costs are high, and these banks often have riskier loan portfolios. They lend to small businesses, local industries, and real estate developers, which can be volatile sectors. Now, with the ending of the Bank Term Funding Program, these regional banks face the added pressure of repaying federal aid funds. This could potentially strain their financial resources, pushing them towards distress. Another significant risk is their exposure to the real estate market. The fact that regional banks hold approximately 80% of all commercial real estate loans is a cause for concern. If there's a downturn in the real estate market, it could significantly impact these banks. With approximately 80% of commercial real estate loans held by regional banks, a downturn in this sector could lead to more bank failures. For consumers, the immediate impact is minimal due to FDIC insurance. This safety net means that individual depositors won't lose their savings, as the insurance covers deposits up to $250,000. But what does this mean beyond the safety of your own bank account? The ripple effect in the market could be substantial. The collapse of Republic First Bank may shake consumer trust in regional banks. In a world where confidence is currency, this could trigger a domino effect of withdrawals, as customers scramble to secure their assets. Furthermore, the impact on the market isn't confined to banking. Regional banks play a crucial role in local economies, providing loans to small businesses and supporting community projects. A decline in these banks could result in reduced financial support for these sectors, potentially slowing economic growth. Confidence in regional banks may wane, leading to increased withdrawals and potentially a banking crisis reminiscent of 2008. Looking ahead, we must consider how the banking landscape could change. The collapse of Republic First Bank might serve as a wake-up call to regulators, prompting them to reintroduce reserve requirements or other measures to mitigate risk. This could lead to a consolidation in the industry as smaller banks struggle to meet these requirements and are absorbed by larger counterparts. Consumers too might respond to the unfolding situation. A shift in trust towards larger, too-big-to-fail banks may occur, as people seek the perceived safety these institutions offer. Additionally, the rise of digital banking and fintech companies could further disrupt the traditional banking sector, offering alternatives that appeal to the tech-savvy and the risk-averse alike. In this evolving scenario, staying informed and reassessing where you keep your money is more crucial than ever. As we navigate these uncertain financial waters, remember, knowledge is power. That's all for today's analysis on the Republic First Bank collapse. Like, share, and subscribe for more videos.